Okay, probably you were surprised about this slide, but in general, we all start like this on the picture. By statistical numbers, 80 to 90% of traders lose money in the long run. This involves as well the banks. And by studying the problems of the traders in all different areas, we can notice the problem of consistency, lack of methodology, gambling mentality, fear and greed, etc., etc. As well, probably you know all, if you start or attempt trading, you can maybe have a few good trades, but later comes periods when losing streaks come and you don't know how to behave, what to do. You made even more mistakes, and all in all, we have all been passed through these stages. In front of the markets, at first, when we appear, we all look the picture. We all think we are traders, mad traders, but in fact, we are not that barely sheeps, which thinks that know something. And no individual institution can manipulate market on a longer time scale. So some experiment was done regarding the market manipulations, and be sure that especially very liquid market cannot be governed even by large institutions like central banks for more than few days. So in this game, market is the boss. We all know that. And best way to learn, if you are interested in Elliott Wave methodology, it's hard work. You really need to work several hours a day. You have to make a lot of mistakes, and you have to have a patience and mentorship from somebody who is already on some level. Some studies, serious studies, approximately calculated for a good trader to develop, to be able to do analytics and trading together, it's around 7 years. So congratulations to any exception to this, but I think this is an objective number of years if you really do all of these things what we mentioned before. Why we choose the Elliott Wave methodology, me and Gregor and I. I will give you just some examples so that you can have a picture of how majority of people actually are involved in the market. So majority of people don't have their own opinion in regards to financial markets. That's a very, very stated truth. They all use other sources, data, newspapers, TV analysts, CNBC, Bloomberg, financial gurus, Google, to make their financial decisions. So most of the people generally don't have their own view on the markets. They pick some things up and there and try to make some picture on the market. But in general, if you ask somebody what the market's about for, he will make up something, because nobody does not have a strategy or a plan in the beginning. You must learn that, you must pick your methodology and step by step build up following things. As regards to markets, majority of people act irrationally. Main supposition in economy as the markets are efficient and the people act rationally on it. But in general, what we saw in many examples, people act very irrationally on the market. My favorite picture is this, which you see here, is where a group of people from one silly world, which is here Excel, derive a sell signal, and everybody starts to sell. And later from a good buy, they derive the buy, and everybody starts to buy. What is following from this is that following a certain system of thinking or methodology gives a space for partial, impartial opinion about markets. What does this mean? It means that if you have something in front of you when you are observing markets, you will use these parameters instead of your own opinion, which is much better. And after some years of practice, it is possible to achieve independence from noise and reduce irrational decisions. So about this statement here, it means that if you don't have a filter through which you are looking the market, in this way a technical analysis or a fundamental analysis based on some numbers or some fundamental data or technical data, whatever, by having this filter, you're reducing your own decisions, and by this you are reducing the mistakes which humans makes on the market. That's why you see today most of the big companies, banks, firms tries to make these algos or computer-based programs which are very efficient and make almost zero errors in execution or in
Go forward.
Okay. So Elliott Wave principle was basically found by Ralph Nelson Elliott. He discovered a social group of behaviors changes in recognizable forms. And then he was observing the Dow Jones as a main tool. He discovered the changeable forms on the chart depicts the structural design which reflects harmony, which can be found in nature around us. And he isolates forms of movements or waves which appeared again and again in the same structure. So he named, defined, and illustrated these forms in coherent systems, and this later became an Elliott Wave principle. So what you have to remember in the beginning, or intermediary system, there is only two things which Elliott Wave pattern consists. There is a pattern and a fractal. And here you can see a Wikipedia source what the pattern means actually. It is apart from terms used. It's a discernible regularity in the world or in a man-made design. So the elements of pattern repeat in a predictable manner. This is a type of a pattern when you see, and fractal are typically self-similar patterns. What self-similar means, they're the same form near as from far. Fractals may be exactly the same on every scale, or they may be nearly same as in a different scale. So if you see this tree, if you cut this branch, it will present this whole tree actually as in the same form. So you have to remember that this when we are looking the Elliott Wave forms is pattern and fractals as a main building block of the patterns. This is the book for the beginners and for the intermediary and for advanced as well, which stands out as one of the best books to begin with. It's Elliott Wave Principle, and it's written by Frost and Proctor. Proctor gave as a chess as an excellent analogy. He said that the markets can do whatever it wants, except it will do it always in Elliott Wave structures. So as Paul Tudor Jones, the one of the famous hedge fund managers from 80s and 90s said, I attribute a lot of my own success to the Elliott Wave approach. So what is the strength and weaknesses in this Elliott Wave methodology? Strengths is that, for one, it gives orientation and identify trends. It means that give you a map, if you know the forms, you can see where you are in some part or in some sense where you are in the trend. Identify counter trend moves in the trend, which means that market always retraces a certain portion, and then this can be identified with the Elliott Wave methodology. Pinpoint the phase of trend, where we are in the beginning of the trend, the end of the trend. Provides with a great probability points of entries and exits from trades. It means that we can pinpoint entries and exits with stops very precisely. Provides the rules, which makes the points where the structure don't provide enough qualifications for trading, and points of invalidations where given forecasts are no longer valid, which gives us a very good information when we are in analysis, in Elliott Wave analysis, we have some invalidation levels, then means that this form or structure is no longer valid. Additional technical studies can help. So you can use additional candlestick patterns or MACD or RSI with combination with Elliott Wave methodology. Weaknesses, it's this what I came from when I was start studying. It takes a lot of study time and practice. Human subjectivity makes it erroneous and difficult for most of the traders. Some forms cannot be recognized until they are completed, and probability of forecast varies on the given time frame. So it means if you're analyzing 1 minute, 5 minute charts, the forms can change quickly because of the noise, unless they're changing when you are upgrading your time frame on weekly, daily, or 4-hour charts.